Hello friends, today we will discuss on one of the important topic of financial statement analysis, and that is ratio analysis. So let's start with type of financial ratios. So first is the liquidity ratio, then leverage ratio, then activity ratio, then profitability ratio. Today we will mainly discuss liquidity ratio. So before knowing liquidity ratio, we need to know some important concepts. The first is current assets and current liability. So what is current asset? The assets which are realizable into cash within an accounting period. It is mainly 1 year. In India, most of the companies having the accounting period as April to March. And what is current liability? Current liability are the obligations of the business or the company which are payable within accounting period. That means the obligation that are payable within accounting period. So what we call it generally within a financial year. Okay, it's from April to March. So what are the components of current liability? Accounts payable. When we sell products, uh, we also on credit, and we also buy products on credits. So our supplier of goods and services that we purchase on credit, that are to be payable. So this comes under current liability. Then notes payable. Formal written promises to pay a specific sum of money at a future date, often to a lender or a supplier. So if short-term loans we have taken, the EMI we have to pay. Accrued expenses. Expenses incurred but not yet paid, like wages we have not paid, interest not paid, taxes not paid, salary not paid, electricity bill not paid. Suppose every month we get a electricity bill of the next month. So March 2025 electricity bill we get it April. So definitely after getting the bill, the company pays. So this will be under current liability. Short-term loans and bank draft. Company uses cash credit that we have also discussed in our earlier sites of working capital fund-based limit and ODs to meet its working capital requirements. So this comes under current liability. Current portion of long-term debt. Suppose a company took a loan of 100 crores for 5 years. So every year he has to pay the principal amount of 20 CR. Okay. So this 20 CR is payable in 1 year. So this will come under current liability. Now components of current assets. Current assets are those which gives us return, and current assets are those which gives a return within an accounting period, within a year, means within a financial year. That means whatever cash we are having in bank, cash in hand and cash in bank, and highly liquid short term investment like in marketable securities, suppose in mutual fund, government bonds, which are almost equal to cash. Account receivable, when we sell on credit, so we have not received the money, so that come under current liability. It is called account receivables or debtors. Inventory, raw material, work in progress, finished goods, all comes under current asset. Marketable securities, short term investment that can quickly converted into cash. Okay, like mutual fund, investment in government bonds or corporate bonds, even gold. Prepaid expenses, expenses paid in advance for services that will receive in the future, like whatever insurance we do for our machines. Companies does it for their machines, cars, bikes, and all. So this insurance is done. So we have to pay in advance. So let's talk about liquidity ratio. Liquidity ratio measures firm's ability to meet its current obligation. How liquid a company is, that can be determined from its liquidity ratio only. So what are the liquidity ratio we have? Current ratio, quick ratio, and cash ratio. Current ratio is current asset divided by current liability. Just now we read about current asset and current liability. And in quick ratio, it measures how more liquidation of the company, because in some companies inventories are not easily convertible into cash. In those cases we deduct the inventory from the current asset and then we calculate the ratio, that is quick ratio. Cash ratio, it's tell us how the current assets are more convertible into cash. So it is not even considering the other current asset also, it is only considering cash and marketable securities. So it measures the intensity of liquidation. So if a company has to pay its obligation, current liability, how its current assets will meet the current liabilities. So this is the first liquidity ratio. This is it is more intense liquidity ratio and it is further. So this is suppose a company XYZ Limited's current assets and current liabilities. So let's go one by one. This company has taken a loan from the, suppose, an applicant bank or for some other bank. Okay, so how much short term loan it is having? 3400. The unit is lakhs. Okay, then it is having a sundry creditor of 2000. Then advance progress payment from customer deposit, this is 300. Advance it has received from its customer. Interest accrued but not paid. Okay, suppose the interest payment date is 10th of every month. So March, the interest of March month is not paid because all the balance sheet are as on 31st March of the year. Provision of income tax. Income tax, we get time. Companies get till September, October, November of subsequent year to pay the income tax. So provisioning, company does the provisioning. Statutory liabilities, whatever the company has to pay, that's come under current liability. Installment of long term loan and whatever other miscellaneous current liabilities are there, these are fed in other current liabilities. So this company is having a total of 77,280 lakhs, or 72 crore 80 lakhs current liability. Now let's come to current assets. So this company is having cash and bank balance of 300 lakhs, government and trust security of 1200, fixed deposit with bank, this is 200. Okay, so this total will come around 1700 lakhs. Okay, then receivables. Sales has been done but payment not received. This is 10 crore. And export receivables 12 crore. Now raw material. Indigenous raw material means raw material purchased from the country only. That is 12 crore. Stock in process is 20 crore. Finished goods is 30 crore. Our total consumer is 2 crore. The total is 64 crore. Okay. Advance this company has paid to its customers. Okay. Sorry, advance paid to the suppliers. Here the advance taken from the customer, and this one is advance paid to its suppliers. Okay, this is asset. Advance tax paid. Mostly in government, when a company deals with the other companies, they deduct TDS. Okay, with the bills. So advance payment of taxes. Other current assets, all other current assets are classified here, and it is 4 crore. So total current assets is 11220 divided by 7280. It will come as 1.54. So 1.33 is the ideal current ratio, and this company's current ratio is close to the ideal, which is good. Now comes the quick ratio. In quick ratio, in the numerator we deduct this portion. Okay, this portion we deduct because it is assumed that in the situation of stress, it is possible that the raw material, stock in process, finished goods and consumables, that the inventory may not be sold and the company may not pay its current liability from these sources. That's why this part is deducted from current asset. So our current asset will be 6,400. We will deduct it. So it will come around 4820. So 4820 divided by 7280, and this will be equal to 0.66. Okay. Now in acid test ratio. The acid test ratio measures the further liquidation of the company, how more liquid the company is, and it doesn't take the total current asset in the picture. It only takes the cash equivalent. So this portion. Okay. So asset test ratio 1700 divided by 7280. It will come around 0.23. So friends, this was all about liquidity ratio. In next slides, we will discuss the other ratios too. Thank you for watching. Please subscribe and comment. Thank you once again.